Hi everyone, hope you're having a great day. So this is part 2 on my series on how small businesses can use holding companies to save tax. So if you haven't watched part 1, it was all about why set up a holding company. And then part 2, which we're going to discuss today, is about the tax advantages and disadvantages. Yes, there is a little bit of overlap. And then part 3 is actually going to be about how to set up a holding company, because regardless of what advertised online, it's not as simple as just incorporating a company. There's quite a bit of work that goes into it. But anyway, with part 2, just a quick one. If you're watching this on YouTube, I have set up a separate playlist for this where you'll be able to see the other 2 parts, or you can just Google how small businesses can use holding companies to save tax, and it will take you straight to our article on this, and you'll be able to see the entire article as well as the other parts of this video series. So it's worth checking that out anyway. We've got some other great content on our website, so naccounting.co.uk. So let's get into this. There are a few different areas where holding companies can really save you tax, and then there are a couple of areas where there is a disadvantage. But let's talk about what the benefits are, okay? Firstly, you've got something called franked investment income. So that was the old word for it, but now we just call it tax-free dividends. Imagine this. If you had a trading business where you make your day-to-day money and it paid you a dividend, you'd have to pay dividend tax on that. But imagine if instead of that company being owned by you, an individual, it was actually owned by another company. In that scenario, when a company pays a dividend to another company, that is tax-free. So in its own right, that's not a massive tax advantage, because in the end of the day, whether your profit after tax sits in your trading company or it sits in your holding company, that's just a matter of risk because it's still in a company and you can't get to it. Although when it's in your holding company, you can use it in other ways to invest without having to pay the dividend tax to get it out. However, that's where the real tax advantage is, not in the tax-free dividend between companies, but the fact that you can actually utilize your dividends, your post-tax profits, to then reinvest into other projects, loan that money to other companies you own or other people you know, and actually start getting a return on that money without having to take all that money out, probably at the higher rate if you've made enough profits, and pay all of that dividend tax. Higher rate dividend tax is 33.75%. Straight off the bat, if you were trying to get that money out yourself so you could reinvest it, you'd lose a third of it. So by being able to just use your holding company for reinvestments, loaning money to other ventures that you've got, you've skipped that bit where you lose a third of that money to dividend tax, and then you have a lot more left over to then reinvest. So that is one of the main tax advantages. The second tax advantage is along the same theme. So let's say you owned a company personally and you sold that company, you would have to pay capital gains tax on that. One of the beautiful things about a holding company and group structure is if a holding company sells a company underneath it, it qualifies, assuming the criteria are met, for something called the Substantial Shareholding Exemption. What that Substantial Shareholding Exemption does is it means that there's no capital gains tax to pay on the profit it made from selling that company that was under it, and all those profits move up into the holding company tax free. Fine, same kind of scenario as before. It's between companies, it's tax free. You still need to pay tax when you get it out. But why is that good? The money moves into your holding company tax free, and then it hasn't been touched by capital gains tax. So at that point, you can actually then, instead of taking that money out yourself, you can then reinvest it into other ventures you've got and get a pretty substantial benefit that way. If you do have a holding company and you've sold your trading company, you do actually have a period of time where you can wind that holding company down and still benefit from entrepreneur's relief, or what is now known as business asset disposal relief. So it doesn't completely block you from doing that, but there are time periods in which time that holding company has to be wound down after the sale of that trading company. But that is another great advantage, the Substantial Shareholding Exemption. The third advantage of holding companies is intercompany loans. You can have a trading business, you can have an SPV. I mentioned it in my last video. You could loan money directly from that trading business to the SPV. The SPV is the company the special purpose vehicle that you invest in property through, for example, or other kinds of investments. And that intercompany loan, it's tax-free. Once again, you haven't had to take money out of the business and pay dividend tax on it so you can then reinvest it. It just went as a tax-free loan to the other company. And then that tax-free loan can then be used as a deposit on a house or other assets that you want to buy. The holding company, though, is a very important component of that because it reduces the risk. A loan is an asset to a business. If the business goes under, the asset can then be sold on to try and repay its debts. Whereas if you pay the money directly to your holding company and then loan it to your SPV, at least if something happens to your main trading business, then that loan is protected and can't be sold on and seized by your creditors. So that is, the tax-free intercompany loans are a very good advantage of a holding company. So the fourth thing, I'm going to try and, let's make it 4 and 5. Fourth is you get relief on a group structure. Let's say you've got multiple trading companies under a holding company. If one of those makes a loss, you can potentially offset that loss against other companies in that group. So those other companies can utilize that loss. You may, without the holding company, you may be able to do that anyway through management fees, but they'd have to be realistic and commercial. But in the holding company and the group structure makes it a lot easier. And then number 5, which I was going to try and roll into number 4, but it is its own thing, is you can have VAT groups as well. Not only can you share corporation tax losses, actually it's possible to just combine all of your companies for VAT, just do one VAT return and simplify everything that way. And also then not have to worry about charging VAT on intercompany transactions, which is better for your cash flows. Those are the 5 main advantages. So I've got a couple of disadvantages that I want to talk about now as well. So the tricky one is, let's talk about the associated company rules as number 1. The simple way to explain this is, since the government decided to overcomplicate corporation tax, because now, if you make less than 50k in profit, you pay 19%. If you make over 250k in profit, you pay 25%. And then there's this rate in the middle, which is effectively 26.5%. If 2 companies are associated, then you would have all those allowances halved, so you'll end up paying that 25% rate earlier on a lower level of profit. Yeah, if you didn't have the holding company, your companies could still be associated just because you've got common ownership. However, the holding company can create further adverse issue in that equation, because the holding company, if it is purely there to just hold shares, then that's fine. It doesn't count as a company in its own right. However, if there are substantial undistributed reserves in that holding company, then what can actually happen is then that company counts as an associated company as well. Your holding company can. And then that means your thresholds where you tick over into that 25% rate of corporation tax are even lower. So you can end up paying a higher rate of corporation tax overall. That's the first downside. So the second downside is when you sell one of your trading companies and then the profits from that sale go up into your holding company and are tax-free under the Substantial Shareholding Exemption, you could then pay those profits out to yourself as dividends and pay dividend tax on them. But if you want to get the preferable capital gains treatment, you have to wind down that holding company. The problem with that is, if you have other subsidiaries that are then trading, then that can make that very difficult to do. That you do end up, depending on how many companies you've got under that holding company, you can end up with money stuck in that holding company when you rather get it out and get capital treatment on it. So that's it. And then the third disadvantage I was going to say, maybe it's more of a warning, not a disadvantage, but a lot of people want to set up holding companies abroad. They want to just charge like ridiculous management fees to their UK company. So their UK company gets that tax relief here where they pay more corporation tax, and then they can then just pay less corporation tax than Dubai, or no corporation tax. Dubai, as an example, there's many other countries with more favourable corporation tax rates than the UK. If that happens, it has to be done on a commercial basis. So if you live in the UK and you want to set up a holding company abroad and then charge management fees for the work you actually provide in the UK, then that is a problem. That is and that is avoidance. So there are targeted anti-avoidance rules around that. And any arrangement where you've got a holding company abroad or a management company abroad where you're charging fees to the UK company to lower its corporation tax, they have to be realistic, and those services have to be provided from abroad. In addition to that, a lot of UK-based assets will always be taxed in the UK regardless of where you are in the world. So just by putting certain assets into the name of an offshore company won't necessarily protect them. There we go. We've got 5 advantages. We've got 3 kind of disadvantages or inflexibilities. And I'm sure maybe there's more I haven't thought about, but they're in my notes. And actually, that's a good point. Check out our article anyway, because it's far more thorough than these videos can be. And it's a really good point of reference if you're thinking about setting these types of companies up. Thanks for watching. This was part 2 of that 3-part series. Check out the playlist, go to our website for other great articles, and I will see you in part 3.